Well, January is a time for Canadians to make some serious judgments about how they plan to deal with their personal economics in the new year ahead. To do that, it helps to have a good understanding of where things stand and where they might go. Tonight, the bottom line is here to try to do that. Patty Croft is a former senior bank executive. Jim Stanford is an economist with Unifor. Preet Banerjee is a freelance broadcaster and journalist, and Amanda Lang is our senior business correspondent. Their thoughts in a minute, but first, some brief background. Well, say what you want about Jim Flaherty, but just don't say he's inconsistent.
The Canadian economy is growing. It's growing moderately. We have continued modest GDP growth. We do what we're doing. We focus on jobs, growth, prosperity.
That's been his constant answer for months now. He's had to be careful. The only finance minister this government has ever had has presided over a rough ride. How best to show that? Probably with housing start numbers, which many economists cite as the best way to gauge an overall economy. Back in 2008, the numbers looked great. Then, when the financial crisis hit, they plummeted by more than 30%. The way back has been slow, but it has come back. How about some other indicators? The dollar has taken a pounding lately. Those heady days when the loonie was worth more than the greenback, long gone. Jobs. These stats are almost like the housing start stats, but with a twist. Unemployment jumped after the '08 crisis and was followed by a slow recovery, but it's hit bumps, and the latest one isn't pretty, pushing the rate back up over 7%. Interest rates. For anyone who remembers the double-digit rates of the '80s, these figures look remarkable. But how much longer can they last this low? And what happens if they go up? This guy has to worry about things like that. Bank of Canada Governor Stephen Pullos.
In the context of firming global economy, especially the U.S., we would expect to see some upward pressure in market interest rates, long-term rates in particular.
So with the start of the new year, how comfortable should you feel about interest rates, about your job, about the impact of a falling dollar, about the economy in general? Good questions. Time for some answers. And let's start on the jobs figure, because that did startle everybody last week. Aberration, or should we be really worried about that?
There's no way to sugarcoat that one, Peter. That was ugly. Almost 50,000 jobs lost. Unemployment rate back up to 7.2%. Now, there's a lot of volatility in the monthly numbers, but that was not all weather related. Having said that, though, going forward, I'm more of an optimist. I think the best chances for Canada are a weaker dollar and a stronger U.S. economy. I've said this before. I'll say it again. The U.S. economy is going to surprise on the high side, and that will create jobs here at home. And the dollar has dropped. Jim, where are you? Are you an optimist?
Yeah, no, it was a brutal number, no doubt about it, but it was a brutal number that came after a lousy year. In fact, I'd say 3 lousy years. 3 years, Canada's labour market, the number of jobs that are created barely keeping up with population growth. The only reason the unemployment rate fell, as you showed in your graph, was because people gave up looking, which is hardly anything to crow about. Right now, it's like our economy doesn't have an engine. We're a car without an engine. There's no real force pulling us forward. Not business investment, not exports. Consumers are kind of maxed out, and government has their foot on the brake, actually. So without some kind of powerful leading force to be creating the initial new jobs, we don't get the spin-off benefits, the sort of overall momentum that we really need in our jobs market.
Yeah, I'd say December we saw a loss of 45,000 jobs, but it was a loss of 60,000 full-time jobs and a gain of 15,000 part-time jobs. So the job quality is deteriorating. And again, if you look at the year being volatile, the whole year you gained 100,000, but 80,000 was in the first 6 months, 20,000 in the last 6 months. So it looks like it's getting worse to me.
I think economists suggest that we watch January and February closely for a reason. It looks a bit like an aberration. We could well see a snapback, but to all the points that are being made here, it's in the context of snapping back to a relatively weak position. You know, we're not seeing robust job growth overall. We're seeing a kind of a humdrum situation, and that's the best case scenario so far.
All right, let's talk about the dollar, because there's no aberration there. There's a clear path downward. Now, depending on the way you look at these, some people say this is great news. This offers us the opportunity to sell more overseas, and it could be good for jobs, could be good for a lot of different things. Problem is for governments, I guess, is the perception right away is this is not good news. Dollar's dropping sounds bad to a lot of people, and the plus side could take not months, but years before you actually see it. Jim, where are you on the dole?
Well, on the perception issue, government itself wears some of the blame. You know, for years, the government said, look at that strong dollar. It's a sign of international respect for our strong fundamentals. And in fact, it's wrong. At par with the US dollar, our dollar is way too expensive. It makes everything we sell, our manufactured goods, tourism, services we sell to the world, look too expensive. So sooner or later, it had to come down. Now they'll probably try to find a silver lining in the cloud, and the silver lining is that the low dollar will help our exports. It will take a year or two before we start to feel any benefit. I expect it to fall further. I'll go out on a limb here. I think it'll be in the mid-80s by the end of this year, because once the currency markets start to move, they move pretty quick.
And Patty, to her credit, has been saying this for a year or so. Preet, where are you on it?
Well, one of the silver linings is for investors. So if you had investments in the U.S., they were up 30% for broad markets, but factoring the fall of the loonie, it was actually up over 40%. Now, the corollary of that, the opposite side, is as the loonie was going up, a lot of people started to hedge their investments for currency. So if you do believe strongly that the loonie is going to go down, you should talk to your investment advisor about removing that hedge so that you can further participate from the drop in the loonie. So that's, for the investment sides, one silver lining.
Markets. You know, I can never figure this out, what we're supposed to think when we watch the markets. They, you know, numbers were pretty good last year.
Especially the U.S. market. So we had a stealth rally in 2012 that turned into just a bona fide rally in 2013, which leaves that market quite overvalued by many measures. People will differ on just how overvalued. Patty's shaking her head, but it's pretty toppy based on a lot of fundamentals. Our market, the Canadian market, which Canadians are still overexposed to, most Canadians really are exposed to this market, if any, it didn't do the same. It didn't perform the same way because we're so resource-oriented. The funny thing is, those may reverse themselves. You're starting to see analysis that suggests because the world is beginning to grow, that means the world needs resources. This might be the time that the Toronto Stock Exchange takes off while the U.S. markets soften.
It's possible, but yeah, valuation is such a tough question. There's all different metrics. I think it may be fully valued, maybe a little bit overvalued, but not stretched by that much. Could we have a 10% correction? Absolutely, that would be healthy. But I think for Canadians, the opportunities this year are not necessarily in the U.S. It was up 40% in Canadian dollar terms last year. That was a huge rally. But Europe and Japan, I think, are very fairly valued, and that's where there could be good opportunities for Canadian investors.
Here's another one that I have trouble with, and I think we all have trouble with, and that's the question on housing. We, you know, whether it starts or whether it's prices. I mean, I think we've all sort of sat around the table and thought over the last year, 2 years, that, hey, it's just about to go down. It doesn't go down. It keeps going up. Preet.
Yeah, it works till it doesn't. So what I would suggest to people is that if you are looking or thinking about buying a house this year, think a little bit longer, simply because there's two things you need to have. You should be expected to be in that house for a minimum of 10 years. And after factoring in all the expenses of home ownership, if there isn't a big cash flow buffer for you, don't buy a house, because all the fundamentals are pointed to an overheating.
Jim.
Well, I'll stick to my guns. Sooner or later, it's going to come down, and sooner or later, I'm going to be right. Exactly when is anyone's guess. We're seeing some downturn on the real side again. Housing starts are falling. Employment in the construction sector is falling, and they really have nowhere to go but down. Canadian housing prices are very high by international standards. They're very high relative to the income and debt levels of consumers here. So if it starts to fall quickly, then that will be a big macro problem for us. If it's a soft landing, then it's probably something we can handle.
I really hope.
Well, one of the things that's interesting, of course, about what's happening in housing, we talked to Polaz earlier this week, and that is this is a market that is being buttressed by low interest rates. So what's happening is exactly what you would expect to happen. When money is plentiful, when people are lending it out willy-nilly, people build and buy things. So we've seen that, and Polaz says 5 years in, you got to start to see it soften. He actually said he would welcome or wouldn't be opposed to another move from the finance minister to try to the way he put it was he's glad they still have tools to do that. So he's not saying they should or shouldn't, but cooling is not a bad thing.
I just hope, Peter, that this is a year we resolve this question, because I think everybody is tired of talking about it. But I think the surprise could be, again, this year, that the naysayers are wrong. I agree with Jim that it's overvalued, but let's be very careful about the difference between being overvalued and a housing market crash. So I do not think Canadian house prices are going to crash. I do think they're going to come down, but not a crash.
On the interest rates, and you know, you talked to the new governor of the bank about this. Is he linked, or does he have to be linked to the American interest rate? And is he willing to break that linkage that seems to have been evident in the past?
There's always pressure. We've seen it in the past. Certainly when people were raising rates in time gone by, there would be pressure not to create a big differential. In this case, our bank, under Mark Carney, got out ahead of everybody else. So all of our trading partners, we are higher than most. So we actually have room to lower rates. And my impression from Poloz is if he doesn't see some improvements in some key areas, especially business exports, he could go that way. So we shouldn't assume that rates are only going up from here. They could go down.
The budget due sometime, we're told, in early February, could be less than a month away. What should we expect here? I mean, they're downplaying, as they often do, what might be in the budget. But what should Canadians be thinking as we head towards budget time?
I actually don't expect very many goodies in the 2014 budget. I think they're saving that up for 2015, the election year. And they're also staying on point, which is we want a balanced budget. That's our goal. We're managers of the economy. And now there are some contingent promises made in the previous election where they said, once that happens, we're going to double TFSA contribution room and we're going to allow income splitting, which has potential great tax saving benefits for average Canadian families.
Jim?
Average Canadian families, if you're someone who has one income earner out there and another income earner at home, if you look the distribution numbers, the distribution effects of that income splitting thing, it's very unfair, very uneven in how it's felt. We won't see a lot of goodies in this budget, that's true. The number I'll be looking for is the budget forecast. I expect Mr. Flaherty to declare that the budget will be balanced or have a surplus in 2015, and that's ahead of his schedule. Now, that won't be a surprise to anyone. The whole thing has been set up to declare this surprise just in time for the election. And in fact, they're underspending their own program spending budgets in order to get that surprise. So it won't be any great triumph. I think it'll be more a sign of the triumph of politics over economics, how this budget comes out.
And it also does work for the opposition parties. You get a balanced budget or you forecast a balanced budget, they can operate off those numbers too in terms of the promises they want to make.
But it would be nice to see our fiscal policy set with something more than just an eye on the next election, frankly.
And when was the last time that happened?
Okay.
Let me pick up on something Preet said just before we go to the break. This government likes to claim that it has been a great steward of the economic management of this country. And it's kind of the major plank in whatever re-election platform they're putting together. Do they deserve the credit they claim on that issue?
I don't think so in 2014, Peter. If you asked me that question in 2010, I would have said yes. But here in 2014, Canadians are concerned about jobs and housing. The unemployment rate is still well above 7%. There was very few jobs created last year. And in the housing market, it's unaffordable for many Canadians. And there's this threat of a bubble hanging over us. So I'd have to say the answer is no.
Jim?
I thought the claim that Canadians were in good hands was always overstated, but clearly this past year, the evidence is growing. To the extent that we got through the recession better than other countries, it was largely because of things that had done before, things like our bank regulations. That meant we got through that crisis without a bank actually collapsing, and that did help us tremendously. But in terms of the government's own actions, especially in the last 3 years since they cut off the stimulus effort, they've focused on more, I'd say, political targets than economic targets, and I think we're suffering because of it.
Preet?
Yeah, I think if you look a couple years ago, you could say Canada was held out globally as being a country that survived the great financial crisis the best. But those exact same voices today are now pointing to the high debt-to-income levels, house prices, et cetera, and identifying Canada as the one with the most amount of danger.
Yeah,
Amanda, you talk every day to people.
Economists would echo all of this, right? That as stewards of the crisis, the big question is what might have been? How much worse could it have been? And on that scorecard, I think they do fairly well. Now eyes are turning to how does it look going ahead? Remember, one of the things they did was reduce their tax income by cutting the GST. They're now struggling to right-size that by reducing spending. Is there a permanent solution there? That might be one test that we could measure them by on jobs, on housing. 2014 looks like a challenge.
All right, we got to take that quick break we were talking about, but when we return, this question. If there's one indicator to focus on, what should it be? Welcome back to The Bottom Line. Patty, Jim, Preet, and Amanda are all at the table tonight. We've talked about a lot of different economic indicators. There are others we haven't mentioned here tonight. But if you were to pick one of any of that larger group that Canadians should be focused on in the year ahead to kind of make the decisions they make, what would it be, Patty?
It's kind of a nerdy one. I've said this before. It's the U.S. 10-year government bond yield. That's your best indicator of the health of the U.S. economy and the world economy. In times of crisis, it's been closer to 1%. Today, it's closer to 3%. It's rising. That's a great sign. The U.S. economy is recovering, and that's fantastic news for Canada.
And I think I've asked you this before.
Where do I find
that?
Bloomberg, Yahoo Finance, the newspapers, wherever.
And it's there every day?
Every day.
You can track it.
Every minute.
Wherever the nerds hang out.
Jim, what's your one?
Well, I'm an economist for the workers, Peter, so I always come back to work and jobs and employment, not just the quantity of employment, as we've talked about, but also the quality of it. If we see the economy starting to churn out good, permanent, full-time jobs with a bit of security, some wages, maybe even pensions at the end of it, then you'll see families start to spend, then you'll see consumer confidence grow, then you'll see businesses investing to meet that new demand. So I still think that the employment outlook is the bellwether that drives everything else.
Preet.
Yeah, I agree. Employment is good, but because it's so volatile, I think for the average person at home, for a 30,000-foot perspective, is to look at interest rates. So if they think the economy is getting worse, there'll be a rate cut. If it's going to stay bad where it is, it's going to hold. And if it goes up, maybe they'll be received positively, like in the States when they started to with the tapering.
Well, I may be outboring Patty on the boring scale here.
Go for it.
But I would say
wasn't boring. We learned something there.
But I would say export businesses. We saw that industry decimated post-recession, and it hasn't come back yet. I know it's something that the governor of the Bank of Canada is watching. We are an export-oriented nation. You want to see growth there, and that'll tie into when rates start to rise and all the rest of it, and of course the good quality jobs.
And the dollar.
And the dollar.
You know, if it goes...
Helped by the weaker dollar, it does help those export-oriented industries
Certainly.
for sure.
Yeah, certainly it does.
All right, to the average Canadian, if there is such a thing out there, what should they either worry about or be excited about that could happen this year? Jim?
Wow, separate from all of those things, there could be a positive surprise somewhere in there. You know, I still put a little Economist Prozac in my orange juice every morning and hope for some upside somewhere out there. And maybe it will come on the export side. You know, the auto industry, for example, and other manufacturing exports are starting to pick up. So there could be a positive surprise there. Maybe we won't experience that housing downturn. That would be good. So there's some things to get you out of bed in the morning, I think.
Well, you know, if you take a look at a globally diversified investment portfolio, a balanced portfolio returned 15% last year. So the stock market tends to look down the road. So someone out there has some optimism out there. It's just not anyone at this table.
Amanda.
I think there's lots of reason for optimism. We live in probably the greatest country on the planet. We have the greatest opportunity.
You're hedging on that one?
I'm hedging. There's always China.
Oh, boy.
Just joking.
Yes.
But we do. Opportunity is here. With the right industrial policy, there's no reason why we can't dominate the next century. We need the right industrial policy. Do we have it today? We could probably argue that at length. But I think if people feel good and feel optimistic, these things actually are self-reinforcing.
Patty.
I'm going to be optimistic as well, but I think the surprise could be the Canadian dollar. Now, it depends if you're an importer or exporter, if this is a good thing. But in the short term, currencies are driven by sentiment and momentum. Right now, everybody's bearish on the Canadian dollar, and momentum is going down. So I'm going to go one better than Jim. He talked about 85 cents. I think we could see 80 in the flash of an eye.
Wow. We got to, and speaking of Jim, we've got to say farewell for 6 months.
6 months, Peter.
Jim is off to Australia with his family. Exciting time in Sydney.
Read a new book there.
Write a new book, churn it out, and we'll hold it up here when you get back. And hopefully we'll talk to you at some point during that time. But we'll miss you on the bottom line. There's no question about that. So thank you all for this week, and thank you as well. And good luck with your planning for 2014.